Good afternoon and good morning, everyone. Welcome to the second BizVal webinar for 2024. I'm Graham Stephen, the co-founder and CEO of BizVal, and today I'm joined by my co-founders Howard Blake and the Finance Ghost. Before we get started, we've had a number of highlights this year, and February's been a massive and exciting and busy month for us at BizVal. We formally launched in the UK and the US. And our new international website, www.bizvalglobal.com, went live a few days ago. I'm coming back off the back of a very successful trip to the UK where we met with partners, clients, and entrepreneurs. And, I think we're just really excited about growth. In the 2 months that we've been, formally international, we've achieved in the UK and the US what it took us sort of 12 to 14 months to achieve in South Africa. So for us, it's a really exciting time. We've also had some new team members joining. We've got a UK country director who's got over 20 years M&A and sell-side advisory experience. And we're in the process of recruiting for new analysts to join our team. And a couple of other things. We've also expanded our offering to include a bespoke startup valuation service. And in this regard, we're working with some of the leading universities and deep tech companies in this regard. And we've also launched our BizVal Next offering, which is designed to help funders prepare for exit and a deal process. So, lots going on. Before we get into the webinar, we just want to highlight we've got an exclusive Cape Town in-person event happening on the 29th of January. It's called Leaps and Legacies, and it's a by-invite event only. We've got a couple of spaces left. So, to any of the listeners today, on a first-come, first-served basis, if you're based in Cape Town, you would like to attend, please, you need to do two things. Reach out to Crescendo by email, so you can send an email to value.me@bizval.co. And you also have to complete a free express valuation. So scan the QR code under the featured item. You can value your business, your friend's business, or even a business you want to buy, and we'll select 2 people from the emails and the valuations in the next day or so if you can attend that event. So there's a few more exciting things happening, so just watch the space, a couple of partnerships. We're really excited about the year. I think, we obviously work very closely with founders, and at every level, it's clear that one thing is always top of mind, funding and where to get it. And how to think about funding. Do you bootstrap? Do you raise money from banks? Do you go to a VC? And that's really the theme and the topic for today's conversation. So before we get started on that, just the usual housekeeping. The chat section is set to private, so only the presenters and moderators can see your messages. But please feel free to add any questions as we go along. We'll either pick these up as we're discussing or at the end of the session. We're also recording the webinar, so it'll be made available on YouTube. If anything comes up, you need to drop off. You can listen to it on YouTube at a later stage. Please also check out the handout section on the webinar and download our latest newsletter and articles. So we're going to briefly just talk about the poll we're running this week. So it's a very simple poll. And I'll get into last month's poll just now, but the question for this week is, how are you funding your business? And there's 3 options. Just call me Bootstrap Bull, a mixture of my own money and others' money, or I'm a fully funded or fully VC-funded business. To touch on our results from our last webinar, we were talking about expanding your business internationally. And really interesting is, more than half our respondents, 63%, said they're looking at international expansion in terms of growth opportunities. Yes, largely a South African audience. And then also looking at cost or skills arbitrage. So, I think it is top of mind. People are thinking the world is global, it's interconnected. How do you grow your business in other markets? So, really good feedback from that poll. So without any further ado, we're going to dive right into the discussion today. I'm going to hand over to the Ghost to introduce the discussion, and let's get going.
Thanks, Graham, and welcome everyone. Really cool to have you here. If you're wondering where the Bootstrap Bull reference comes from, it's clearly too long since you watched Pirates of the Caribbean, so find some time and sort that out. But on to more serious things. We've seen it many times among founders, and even in the years before we've started BizVal, between the 3 of us, is loads of dilution along the journey, and eventually a potentially really bad outcome where founders are sometimes actually forced out of the business that they built. And sometimes it's at a very high profile level, big US startups, and they leave under a cloud and it's a whole thing in the headlines. But unfortunately, that also plays out quite often actually in smaller companies. And it really comes down to the amount of capital raised along the way, the type of partners you're bringing on board, a lot of the structuring around that kind of stuff. And I think what's inspired today's webinar is very much around just understanding the importance of finding the right partner. And I suppose not being seduced by the first bit of money that gets thrown at you. That's quite important. This is not pocket money. This is literally the lifeblood of your business. So I know we're going to tap into some of Howard's knowledge first. And I think, Graham, you've got the first question to go there, but that just gives you a flavor of why we think this webinar is actually really important today.
Great, thanks, Ghost. So Howard, you're both a chairman and an investor in Bizval, and I think many of our regular listeners will know you've been involved in so many businesses over the years that you've lost count. But at heart, you're an entrepreneur who has had to build companies. The money is one thing, but how important is it to get the right type of investor, and how do you know that something is a good fit?
Thanks, Graham. It's probably one of the hardest processes to run in my career. The first opportunity came along when someone was interested in taking some equity in one of our first startups. And I think what our audience needs to understand, and I'm sure many do or have bits or pieces of this experience, is that this is a dance with wolves. You're not, there's no such thing as free money. No one's running through the door to give you something for nothing. And you're going to have to accept you're dealing with professional money managers, and you might not have the same level of expertise or experience in the lending market or the borrowing market as they do. So you just got to bear that in mind. First of all, the right investor for you would be someone who aligns completely with both your strategy and the operation that sits behind that strategy. And I really want the audience to dwell on that, because the strategy that you're deploying to grow will need funding. The operation will be the manner in which this is executed. The execution phase will be carefully watched and monitored, and you want somebody who's investing in your business who understands where the strategic vision is going and how the operation is going to roll out that strategic vision. The last thing you want is anxiety building in the lender who thinks it's not being deployed fast enough, or he can't or she can't get line of sight of where the capital is being deployed and for what reason. And that's why a basic understanding of the operation, a complete and absolute in-depth understanding of the strategy behind the lending is a very critical component. So nobody goes to a market, or no one looks for money unless they've got an idea to fund, right? You don't just want to shore up your cash reserves with nothing to deploy the capital against. And that process can be exhausting because you're going to have to deal with legal, you have to deal with due diligences, you're going to have to deal with people snooping through your business and asking all sorts of questions and coming to terms with the fact that they're going to be placing a large amount of money at your disposal within your control, and they're going to have to build an element of trust for you to be able to do that. Understand you're going to have their legal teams, which are going to be highly tenured legal teams who do this often, and you will need to get good advice and good direction during this process. But again, you have to understand why you need the money and how you're going to deploy it. The why and the how are the two absolute critical components. And the way you put that together also builds credibility with the market that you're asking to lend you the money. So it won't come for free. It won't come without anxiety. But the last thing you want to be is in a situation where, through misunderstanding or confusion, either at operational or strategic level, you start getting into some discussions with your lender. You really want everything associated that to be absolutely clear. And remember, taking funding from a third party to help you grow your business can be a chokehold. Don't think for 1 minute that it comes without terms and conditions. You don't ever want to be in that chokehold situation. So, yeah, the only advice I could ever give you about choosing the right investor is to make absolutely sure you understand why you need the money and they understand how it's going to be deployed.
Howard, I mean, maybe, I think that's really useful. And before I hand over to Ghost to ask sort of the next question is, I think it's really important as a business owner, sometimes you're desperate for cash to grow and even to execute your strategy, even if you've got that in place. Can you maybe just touch base on, in finding that right fit, how important it is to actually do your due diligence on the investor and or the potential investor? And what are some of the sort of questions we should be asking the investor before we kind of get into bed with them, so to speak?
Yeah, so what happens is when someone approaches you, I mean, I had it a couple of times, some of the big banks and people came along, they loved the business we were involved in, highly cash generative, and couldn't wait to get a stake in it or lend mezzanine level funding into it. You've got to, first of all, understand the credibility of the lender, and you've got to due diligence that lender. Don't just be flattered. Don't be overwhelmed. Go and have a look. Where do they get their money from? Why are they investing? What is their objective when they invest in your business? Because those are going to become very, very hard questions later on. Often it's linked to an equity stake, which will mean that you will be diluted. And then they take the equity stake and they plug in a mezzanine funding line to you, or a funding line to you at a fairly high interest rate, because mezzanine funding is never cheap money. And you have to be very clear on what you're deploying and very confident in terms of what the performance is going to be and the return on that. But you've got to go and make sure who you are getting into business with, whose money are you taking, and where did that money come from. So a very simple thing: what happens if the person who's getting involved with you cannot go through FICA, or is unable to qualify? And I speak from experience in this regard. I've known of a situation where the lender battled to get FICA, and you know what that means: your bank account gets suspended. So they might sound like trivial details, and that's where good legal help helps. And that's not your mate who's got a law firm. It's someone who understands funding and understands corporate finance and can help and steer you through these pitfalls there are.
Thanks, Howard. Guys, I think you've got another question, so hand over to you.
It's a lot of great points there, and I think the idea is not to terrify people today, but it's certainly to make them understand that this is complicated stuff and you need the right advice and everything else. And also, I think you've touched on an important point there around planning, and that's part of what we do, of course, is just helping founders understand what does that capital raising pipeline look like, when might you need the money. It's that sort of strategic financial modeling piece, and this is because often you need more than one round of capital raising actually to get your business to where you want it to go. I mean, the dream is to need no capital. Second prize is to need it once, but most companies, if they're going down capital raise territory, are probably going to raise more than once. So in your view, Howard, how important is it to maybe bank the investors day one who will support follow-on raises, or can founders actually get away with just treating each round as a separate project?
I gave this some thought, Ghost, before, when we prepared for it. But I always try and draw back on my experience. We've got some proper scars from taking a few wrong turns. But I wouldn't ever advise anyone to view this through the perspective of a single raise. Even if you are only going to do one, look for someone who's got some legs to go through a Series A. Series A is the first round, formal round. I know people who've started a Series A and gone right through to a D. So it's 4 rounds. And I'm sure I'm absolutely certain when somebody goes for a Series A, they haven't got in mind of going through to D. They think A is going to be the last one, and it's all going to be wonderful, and off they go. So you've got to anticipate more than one funding event, and you've got to find someone who's going to support support you in having more than one funding event. I'll tell you why. I've recently been involved in one, in advising on one where there was a single event at the start. There is a requirement now for an additional round for a very verifiable and good piece of technology that needs to be acquired and put into this business, and they don't want to do it. They've lost their appetite for it. Now, if you bring in a second party, there's funding conflict, and the first person who's come along and funded is now going to feel a little bit vulnerable, and they might dig their heels in, or they might see it as a lovely earn-out event. If they own a bit of equity, they might say, fine, take me out at 10x and bring your new partner in. You don't know. It triggers all sorts of funny behaviors when there's a single event and the second party comes along who's willing to do it after the initial one is refused. So I think you've got to be really prepared to go multiple rounds, even if in your heart you think it won't be necessary. Rather structure it like it right at the start, because you will have funding conflicts down the road, which you can engineer out of the equation right at the start.
Sorry, my mic was on mute. I think we made the comments. Sometimes finding the right funding partner is harder than finding a life partner or husband or wife. So you got to do the due diligence properly, and it is a long game, and it's not about simply taking the first money that comes along. It's around doing that due diligence. Howard, I think something we touched on yesterday is also, we're talking about doing that due diligence is check their track record. So when a VC or funder is investing in you, go and ask them if you can talk to other portfolio companies that they've invested in. Go chat to those CEOs, go chat to the founders, and get their feedback as business people rather than investors as to what the experience has been. So we've spoken a bit about finding the right partner, how you think about capital rounds. And on the one hand, we've got the concept of bootstrapping, okay, which is, the sort of, for any of you who've watched, some of what is it? I think it's I forget the name of the series, but it's about the restaurant owner in New York, just like trying to battle to make payroll or buy stock, that sort of glamorized view of bootstrapping and just scraping by the skin of your teeth. And on the other hand, we've got, the VC world where you get a big check for $100 million and off you go. But the reality is, for most of us, it's somewhere in between. And Howard, we've heard you talk before, and there's an article in our latest newsletter about this concept of hybrid bootstrapping, and I think it's a term that you've come up with. What does that mean to you? Why did you come up with this term, and what does it actually mean in practice?
Graham, I think, the hybrid bootstrap, and I think that's just the most glaring example we have is the one we're doing today, Bizbel. That's a really glaring example of a hybrid bootstrap. When we all sat around the table and decided to get involved in the business, some of us did income sacrifices. We all funded it in our own way. We gave our time for free, but we needed to build a piece of tech, our websites and our digital strategy piece, and that required funding. But we had a line of sight always of when the revenue could be generated. In actual fact, if we had chosen not to do the e-commerce solution, we could have just put a basic website up and acted as consultants and, executed the evaluations on a consultancy basis, so it could have earned all its revenue day one. It could have been profitable day one, and we could have chugged it along. So that's a classic bootstrap, right, where you don't put any money in, you make sacrifices along the way, and off you go. We chose the hybrid bootstrap because on the fully funded model, where someone throws $100 million at you because they believe you're the next Bill Gates, and off you're going to go and build another Microsoft, that's fine. But we don't deal in that market, and we understand it's there, but just watch how long they take to get to profits. And I don't have to read off the list to you: Amazon, Uber, Airbnb, yada yada. We can go on forever. They take forever to get to profitability, so we don't deal with that. So we're talking about where there's a reasonable prospect of income generation, revenue generation in the very short term. And this is where the idea is seeded, because when you know you're going to be earning something out of it, but it might not be enough to cover all your expenses, what a lovely way to be able to sit like we do at the end of each month and decide how much funding is going to be required for the next month. It's a really great governance tool where it's not just, here's $20 million for Q1, off you go, and we'll review at the end of Q1. This means that everybody's very involved, not only conscious of what we're spending, but conscious of what you're asking for in terms of the funding side of it. So like in Biswell's case, we've got a great asset with great value, but we actually haven't spent that much money in developing it because we've done it on this hybrid bootstrap basis. And I think it might be a difficult concept for the formal market to engage in, but I think there's many people informally who are engaged with it when uncle or mom or dad, a relative, an interested party, or someone's helping them along. And a lot of this, I think, exists informally, and it's not spoken about because it doesn't really fit into the business school model of funding models. But it's a very, very real one. And what it does is it allows an enterprise to grow at a good rate, a nice, steady, sequential rate, without having pressure of all this capital not deployed, or without the pressure of not having enough capital to deploy. So for us, it's been, I don't know, I found the process really exciting. It's not the first one. Silvery Jewelry is another bootstrap hybrid in a way. And there's one or two other bootstraps that we're currently involved in that are all hybrid arrangements as well that are really going well, which means that the management team have to justify each monthly draw based on the trading circumstances. And it's very quick to see whether the revenue and the profitability or the break-even points catching up or is in sight or not. So I think in the Biswell case, what it's helped us do is we've been able to deploy capital to be really agile on the building of the digital assets. Those are, everyone looks at our webpage. That's the primary interface. Events like we're hosting today, we spend money on that. The way the public see us and the way we present the service digitally to people. And that allowed us to really gain great traction because we had a great digital team who were able to put that together. We also have a very certain formula in the way in which we marry our search engine optimization to the digital content, and we're able to accelerate that. So we understand, we have other business models that allow us to understand how the revenue flows from it, and we're able to do that. But it really is a great alternative. Maybe it's one that's going to become more mainstream. I don't know. The Ghosters will be better qualified to comment on this, but I don't know. You don't hear of SPACs anymore, or you might hear of one every 8 to 12 months, and you don't hear much of unicorns anymore, which means the market isn't looking for the next financial messiah to stroll in the room with some really great scheme, and that's going to make everyone billionaires in 3 months on Instagram. So, I think the market, the finance market's definitely, there's a point of maturation around what's happening now, and I think this is an incredible way to be able to fund startups and get them going in a very responsible way, a really responsible way, and it's been exciting and interesting for all of us. Thanks.
Yeah, I think
I was just going to say, Graham, sorry, just the point around the way the market's changed is absolutely spot on. Something like the Meta, so that's Facebook share price performance over the past years, almost entirely been driven by them cutting back on costs, focusing on free cash flows. And I'm seeing that language everywhere. Uber, Airbnb, Shopify, it doesn't matter where you look. When interest rates move higher, then investors, yes, they want to see growth. Of course they do. But it can't be growth at all costs, and it can't be growth without reference to when this thing goes free cash flow positive.
Yeah, 100%. And Ghost, I think I'll make a couple of comments, and then I think there's some appropriate questions we can actually jump into before we ask you a few questions. But yeah, I think one of the benefits, I guess, as a founder or someone who's actively in the business of this sort of model is that you can take slightly longer term decisions. You're not necessarily worrying about where your school fee check's going to come for at the end of the month if you've got kids, so it helps you to think 3 months or 6 months down the line rather than just doing things that might bring money in but compromises how you execute on your strategy. And it also allows you to say, look, if you want to enter a new market, for instance, really simple practical stuff like it costs money to get in the plane and go spend a week in London. So this hybrid bootstrap model kind of almost evaluates each of those opportunities on their merits. It's almost like a project-based approach. And we've certainly, it's helped us from Biswell to focus on building rather than focusing on just keeping the lights on all the time. But at the same time, it keeps me as a CEO accountable on a regular basis rather than just having 2 years runway at a time. So yeah, really interesting model that's worked well for us. Go see a couple of questions, and maybe we can jump into the first one from Papama. Is back in the first section, Howard, you spoke about funding conflicts. Could you maybe give an example just to illustrate the point around potential funding conflicts?
Yeah, funding conflicts are interesting things. So I'll give you a case in point. There's one that we're involved with at the moment where a particular piece of a stake was taken pre-COVID. Obviously, everything, and this is at a major investment banking level. So this is not a rich uncle who's chipped in a bit of money. So formal institutional investor came along, took a stake, gave development capital through to the business to achieve certain things. COVID came along, cleaned out the till because they had to keep all their staff on board while they waited. It's a business that sits in the medical services arena. They held all their doctors up, chewed up the capital. Post-COVID, the business takes off again. They still need the piece of tech. They still need to integrate it, but the capital been eaten up by another event. And now, when the shareholders request, or when the operational shareholders request additional funding to put the next layer of tech in, it's a no. So they go out, find another investor who's prepared to put the capital in under the current shareholding arrangement, and the existing investment banker says no, not happening, not on my watch. We're not going to put in, and we don't accept that they think deserve a controlling vote because they are the funders, right? That's often what happens. When the funder comes along, you give away control. So it might be negative control. You might still have 60% of your business, but the way the shareholding agreement reads is very simple, that the funder has control. So they have negative control of your business and they can make those calls. That's the most classic conflicting case. And I've seen it time and again where someone's come to the business, they might have lost their love for it because of an event, needs a little bit more money. There's nothing wrong with the business, but they, on principle, are not prepared to do it because it doesn't fit their investment framework. And you're either going to get green-mailed, that person's going to green-mail the excited party into coming in, so they're going to pay way over the odds to come into the business if they do sell that stake and allow another funder in. But those are the kind of conflicts it creates. It also creates a very unhappy environment on the board and at a shareholder level. And it makes it difficult because you're now funding strapped. You've got the person who's got the deep pockets won't give you the money, and they won't let somebody in to come and help you.
You're on mute, Graham. Rusty after the pandemic. Rusty after the pandemic. He's been having too many meetings in person now. He's forgotten how the microphone works.
Exactly. And then I think there was a question from Chris just around FICA. I think she answered that in the chat, but being a South African versus international discussion. So Chris, I'll drop you a private message, but FICA, KYC, I think it's used in other jurisdictions. So I'm happy to also have a chat with you offline if necessary. And
Graham, I did want to elaborate on that point just for everyone, because I think the chat's private. I'm not sure everyone can see everything, but the point was FICA might be a South African name, but the reality is that know your client is only getting more and more hectic internationally. I mean, remember, South Africa's been grey listed around some of our financial processes. We've had to up them. And I can assure you the South African government is not often sitting around dreaming up regulations that don't already exist elsewhere. So the concepts here travel very well. The name might be different, but the concepts, and we've confirmed this through multiple podcasts and conversations with international investors, international founders, it's actually incredible how well the concepts travel.
And Ghost, just to add to that, that FICA event that I referred to, while it fell under the South African Regulatory Authority, was actually a Swiss entity, not a South African one. So this isn't limited to South. This can happen globally to you. It can happen to you anywhere. You make any deposit in the bank, they want to know source of funds. It doesn't matter.
100%. So, Ghost, I think let's ask you a couple of questions, but put you on the spot. So, we're talking about bootstrapping, raising funding. There's different types of capital, so we have exit capital when somebody's selling their business or new buyers coming in, and growth capital. I think a lot of today's focus is around growth capital. But what are the differences between the two? And, how do investors think about these types of capital? And are there any alternatives to achieve growth with any equity dilution? So that's a long question, but you're far more eloquent at explaining these than I am. So I'll throw that over to you.
Listen, I'll just remember to put my mic on first. I mean, that's going to be the starting point here. No, I'm just kidding. So basically, the trick is in the name, right? So exit capital, that's when you walk away. You sell your shares, you go and play golf or sail the world, or, maybe live a quiet retirement if you didn't quite get what you wanted, AKA the dream, I suppose, at certain points in life. Whereas growth capital is very much about taking the business to the next level. Now, that's also the dream, just at an earlier point in your journey. The important thing to remember here is exit capital means money flows from an investor to a founder or an exiting shareholder. It can be any shareholder, actually. In the other, which is growth capital, money flows from an investor into the company bank account. So that makes the company's balance sheet bigger. This is when you hear comments like pre-money versus post-money valuation. So when it's exit capital, the investor has to be happy that you are leaving. So that means handover becomes incredibly important. Owner independence, succession planning, all that kind of stuff. And a lot of the conversations we have with entrepreneurs is at this phase in their journey. Maybe that's a function of where the economy is at the moment. A lot of people are looking at it and thinking, okay, maybe it's time to start getting out of this thing from a risk perspective. But growth capital, that's a bit different. The investor now is looking for a founding team, or at least a management team, to walk alongside them. And as the founder, you're not looking to exit. You're looking to actually get that investor in and use that money and grow the business accordingly. And sometimes it can be a hybrid structure. It sounds like the conversation we were having earlier. Sometimes you partially exit and you raise growth capital. So you de-risk yourself, you take some money off the table, and money comes into the business for growth. That's best of both worlds. Hard to achieve, but not impossible. But, the second part of the question was, how can you achieve growth in your business without necessarily diluting your equity stake? So I think the thing to do here is to understand, why do you need the money? And what exactly is it that you need the money for in order to achieve growth? So do you believe that you could increase your sales, and you've decided that you need more money to do this because you need to do, for example, more paid marketing? Now, paid marketing is only one route to increase your sales. You can do stuff like thought leadership, unpaid marketing. You can do different routes to market in the form of partnerships, where, for example, you do affiliate type deals and you try and find partners in a market you're trying to hit, and you do deals with them where they take a share and you take a share. Now, you haven't actually diluted your entire business. What you've effectively done is you've diluted the economics that you can extract from that particular initiative. Another great example is, do you need to bring on full-time staff, or are there professional people who you can do transactions with on a commission-based structure, where, again, you're not allowing someone onto your shareholder register, you're just doing another deal. I was actually in a client conversation the other day, and I used this analogy and it seemed to resonate so well, which is, when you bring in another shareholder, it's like having your extended family stay in your spare room, but they're never going to leave. You might love them, and I'm sure they love you, but you are still, now you have someone else in your house. You can't just stroll around in your living room wearing whatever you want anymore. And it's that way of thinking. Alternatively, you can just go on holiday with your extended family, go stay in Airbnb somewhere, create all those memories, and go back to your own house. That's the equivalent of doing stuff like partnerships, commission structures, all that kind of thing. So, there is a way to grow without equity dilution. The point is, you dilute some of the economics, but you're not diluting your shares.
And guys, I think that's quite an important point. So, when you're tending towards the bootstrap side of things, sometimes you got to get a lot more creative in terms of how do you do that, right? Because you don't just have the cash to go and spend, for example, on paid marketing. You got to think about partnerships. You got to think about these things, and I think that's a good thing, because I think often when you're building a business, and that's where bootstrapping is so powerful, is you got to think out the box. And sometimes it's a lot less wasteful, but at times as well, sometimes you do need a little bit of a punt to get your website properly SEO ready, and it needs money to be able to do that. So yeah, there's a whole spectrum over there, and I think most business owners, as you mentioned right up front, they don't want to only have 5% equity left when they exit in 5 or 10 years time. They want to retain as much of that equity as they can. Howard, I think you've got a question for Ghost.
Do I?
I can handle it.
No, you can ask him. Sorry.
So guys, we also talk about sort of convertible instruments, and it's often used in early stage companies raising growth capital. So convertible instruments, mezzanine finance, all these different things. Can you walk us through what this looks like and why these structures are popular for investors?
Yeah, absolutely. So convertible is very much a best of both approach. So this is where an investor is trying quite hard to come in and have their cake and eat it. So convertibles, good example would be something like a convertible preference share. And basically, there are a billion ways to structure these things. They're often called mezzanine structures because they kind of sit between debt and equity. It's basically an instrument that has debt-like characteristics when the company is in trouble or not necessarily spitting out a lot of cash. And I'll explain that now. And then they also have equity-like characteristics to try and capture the upside. So the investor is getting some downside protection and upside participation, hence best of both. Now, the extent of protection and participation actually varies. And on the protection, you'll see things like, for example, a preferred dividend. So all that means is, before the ordinary shareholders are taking a dividend, this investor is going to earn a preferred dividend, and it can be at a very high rate. So for example, they can look at it and say, okay, my required rate of return from this business is 30%. So that is the coupon on this preference share. I need to earn a 30% return every year on the money I put in before the founders are getting anything. And what often happens is that preference dividend actually accrues every year, whether the company can afford to pay it or not. So it becomes a cumulative preferred dividend. So in the years where you can't necessarily service it, that then is busy racking up, and eventually you've got some free cash flow, and that preferred investor, as the name suggests, is going to get the bulk of the money for quite some time. What also happens often is in a liquidation event, it has special rights or events that look a bit like liquidation. Pretty much the sky's the limit with the creativity in this stuff. And on the upside, what often happens is this instrument just converts into ordinary equity when there's a trigger like an exit, for example, or a capital raising round. So what that's doing is it's making sure that the investor doesn't lose out when one of these upside events actually comes to pass. Now, this may all sound very one-sided to you, and that's because it is. The reality is capital is difficult to raise for startups. Unfortunately, and this is a passion point of mine, is a lot of the global content and literature is written by Silicon Valley success stories. There is serious winners bias in it and US bias. And neither of those things are applicable to most venture capital markets in the world. I had a great lunch the other day with someone from Germany who is very involved in the VC and startup space in Berlin and goes across to the US all the time to raise money. And it confirmed what I've always believed, which is pretty much outside of the US, nothing else works the way it does in Silicon Valley. So capital, it's hard to find. It comes with lots of conditions. And, unfortunately, investors are aware that their capital is very valuable for early stage ideas that may not get to market without the capital. Of course, the more you can prove the idea, and especially the more you can prove revenue attached to it, the more negotiating power you have as the founder and the less one-sided it would be. The worst time to raise capital is always going to be when you have an idea on a whiteboard. Every time after that, it should theoretically get a bit easier because you've done more. The beginning is the hardest.
Thanks, guys. I think that's super helpful. So we've got a few minutes left, and I don't see too many questions. I know, Ghost, you've got a couple of questions that you wanted to steer towards me. So just to our audience, if there's any other questions, please pop them into the chat. But yeah. Ghost, yeah.
There were two from Ishmael, but maybe Ishmael, if you can just expand on them while we're answering the next one, because you asked long-term or short-term. If you can just be clear on what exactly you're asking there. Is the type of funding or the type of investor, and also the main levers or success factors. If you can maybe just message us and just give us a bit more information on what you're asking there. But Graham, while we wait for that, I think a lot of the inbound calls that we're getting from founders are landing at you because you have a very pretty photo on LinkedIn, mainly. No, I'm kidding. And obviously, it becomes quite apparent quite quickly in your conversations with these founders what their pain points actually are. So I think it would be great to understand, when these founders are speaking to you and they're planning an exit or they're planning growth capital, actually, have they already had discussions with investors? Have they kind of tested the market and gotten a bit scared? Or have they foreseen that they need to get some advice before they actually do that?
Guys, it's a great question. And I think you rightly said there's definitely what we see with our clients is that there's two types. There's owners who early on in their growth journey, and then there's owners who later on in the growth journey, and they're either looking at exit planning or they're looking for more funding to be able to take their business to the next level. And I think the things that we find that you really need to think about, okay, is that do you actually need to raise the money? So what are you giving away, and can your business self-fund the growth? So often founders get into a bit of a space and their default is, I need to raise money. And then when you start asking the question around, do you actually need to raise money, and what are you prepared to give away, it becomes quite apparent that it's not necessarily a money raise thing. It's something else, So we also do find that, probably 70 or 80% of our customers who come with this question is they haven't necessarily had an approach. They're starting to think about it, and they're looking for some guidance and a steer on what their choices are, what the options are. We finance professionals, so we understand the stuff. We talk about it on a daily basis. But I think the average business owner doesn't. They've heard somebody at a briar talking about raising money or an exit check, whatever the case might be. And I think it is really, a lot of it is about education. I think I find that a lot of business owners don't necessarily understand the difference between debt or equity. We've seen a lot of businesses who grow quickly and they take on expensive short-term debt to fund that growth, when actually what was needed was an equity stake or sort of a longer-term secured debt. So there's a lot of ignorance is the wrong word, because I don't think business owners are ignorant. I think they're optimistic. They see the best in people and they're just trying to grow their businesses. But there's a lot of education that needs to happen. And we do see a lot of this where business owners have taken on the wrong kind of funding. They haven't gone through that due diligence up front. And then now suddenly they're looking to raise equity to settle very expensive short-term debt, which was the wrong funding for the project that they did, for instance. So that goes back to is, why do you need funding and what type of funding is appropriate? That's always the question we go back to. And then just very briefly, owners on the exit journey, our experience is, again, odd occasion, somebody's expressed an interest, but usually when owners approach us, an investor hasn't approached them. They're starting to think about an exit. They're starting to say, well, what's my business worth? And the reality is this is not a quick process. It's not like selling a secondhand car online. It's you actually got to go through that process of, is a business sellable? And if you do that properly, then the sort of funding or who's going to buy you out question becomes a lot easier. So that's kind of been our experience over the last 18 months and globally. Not just in South Africa, we have the same feedback and the same sort of questions in the UK and the US as well. So that's kind of been some of our experience over the last year and a half.
Graham, I just want to answer Ishmael's question quickly, because I think I can get it out in the middle of all of this. So in terms of the timeline, it was sort of long-term versus short-term, and it's been expanded to say, for government, 5 years is short-term thinking. How about for the private sector? So private sector, 5 years is not short-term thinking. You've got to remember, private equity houses are generally on a 7-year cycle. So that's your typical sort of private equity investment horizon. Short-term in the private sector would be sort of a couple of years. That's the sort of handover period. We often see earn-out structures and that kind of thing. Once you start to get to 7 years plus, that's getting quite long-term for private sector. Anything beyond that, you're starting to talk about what's called a permanent capital vehicle, which is a wonderful thing because they never actually have to sell out. Private equity investors have to sell out if they have that type of fund after roughly 7 years. And then the other question was just around what are some of the main levers or success factors? And if I understand the question correctly, the example is, what are some of the levers when you're dealing with funders? So I think one of the things that helps, that I'll just comment on, and then we'll get back to you, Graham, is it really does help if you've got a lender coming in or an investor who has a lot of credibility already. So what will happen is you attract a really, if you're going to have more than one investor, once you've attracted your first big name, then you get people riding on the coattails. And especially private equity, they love doing this. And it's the old no one gets fired for hiring IBM point. If this big investment house invested and we invested alongside them, well, then we're all idiots and we all lost money. And so, it couldn't have been our fault. But if you go out there on a limb and you're the only house investing in that asset, then you live and die based on that due diligence. So it does actually help to have, if you're going to do a big raise like that, and now we're talking really big commercial raises, sometimes multi-billion rands or hundreds of millions of dollars, you can then bring in a credible party first and then hope that will help you. But that's really, really on the big stuff. On a lot of the smaller stuff, it does happen in VCs, of course. So you have established VC investors, and if one of them is coming, then others will sometimes jump in on that basis. Howard, I think
Thanks,
there's one
guys.
more for Graham.
Yes. No,
shareholder agreements. Oh, is it for me? Oh, fun.
Yeah.
We'll wrap quickly because I think everyone's getting tired, and the next meetings are starting in 15 minutes. So we'll make this the last one.
Okay. So, to what extent do you think business owners understand all the nuances that come along with control clauses and shareholders agreements?
So I'll give my view, and then I think I'll let Graham jump in on that as well. But I think that a lot of them don't understand any of these terms because they've never seen them before. So it's very hard to understand something you've never seen or to know that it's coming. It's a bit like asking me to do a really high-end building project. I'm not going to have a clue. Doesn't mean I can't figure it out if I haven't been taught, but really I don't know how to build a house. So for business owners, and this actually goes right back to the Dancing with Wolves point. For most business owners, they'll raise money once in their lives, or they'll sell a business once in their lives. That's already a big deal. Whereas a lot of the investors sitting on the other side of the table, this is what they do for a living. So this is like me rocking up to play golf against someone on the Sunshine Tour and hoping it's going to go well. That person is playing 4 times a week, and I'm playing, if I'm really lucky, twice a month. It's just not going to go well because I haven't seen it before and I just don't know what I'm doing. So all these sort of control clauses, all of these tricks, a lot of the really ugly stuff that gets used in earnouts and putting other expenses through that are nonsense to try and squash the profits, all that kind of thing, I think most business owners are quite horrified by down the line. And, the worst part is when that expression of interest first comes in on a deal, it doesn't specify all the stuff that's coming later when you start negotiating transaction documents. This is a nasty surprise months down the line because the investor is now relying on the fact that you've tasted that money. You've already you've told your mates, you've gone to the braai or the barbecue, before I got told that's too South African, and you told your friends you're raising money, and now suddenly you aren't anymore because you were too strict on the legals. It's difficult. So they rely on the fact that you've become emotionally invested before they bring a lot of these clauses. Graham?
Yeah, go start that. To me, I think it's a lot of the time these all these hooks have barbs on them. And you got to watch the barbs. They don't let you off. There's no let off without whether it's a ratchet or a conversion or whatever the tricks are that sit within the documents. These guys are not going to leave without getting their pound of flesh, especially if the capital's at risk. Sorry, Graham.
Yeah, 100%. And then I'll wrap up on that. I think we've made this point a few times, is that bootstrapping has its own set of pains. Where's the money going to come from next month? Short-term decision versus long-term. All those kind of things. Can you grow quick enough? Raising money is not the silver bullet everyone thinks it is. And to that question you asked, I think most business owners don't know what they don't know. They can be quite naive when it comes to it. And the point I'd leave our listeners with is that when it comes to this, you've got to take a step back from all the legalese and focus on the intent behind these clauses. So what type of investor is it? How they're trying to protect their own interests? Don't be naive about that. And it is important to have somebody in your corner who's walked this road before and not seeing this stuff for the first time. So I think just to wrap up, and I think today we only scratched on the surface of some of these things. I'd really encourage everyone to go and read our latest article on hybrid bootstrap versus raising money. I think that's a lot of meat in there as well. We cover some of the topics we covered today. And we really hope that you all found today's session valuable. Maybe just a closing remark, Howard, from you and from Ghost. And then we'll wrap up. Our next webinar is going to be towards the end of March. But yeah, maybe just a closing remark from each of you.
I just think that the audience don't allow the fact that we point out pitfalls to not do these things. You've got to go and explore. And we all learn our lessons, but you know what? Go and learn the lessons with great advisors at your side.
I think my side is don't be scared by bootstrapping and thinking that that doesn't work. And the one book that I always recommend you read is something like Shoe Dog. Nike is really the result of some pretty hardcore bootstrapping in the beginning. The founder of Nike had to kind of hang on to his financy job for a long time. He was selling literally boot full of, the old joke of selling shoes out the boot of his car. There was a lot of bootstrapping going on then, because that wasn't a time in the world where this VC money just dropped out of the sky and allowed you to go and hire a team of 20 developers and build a product. So, I think just read widely, and I think give yourself exposure to different types of stories. Don't think that the Silicon Valley coffee shop is also how it's going to work in even places like London, Berlin, Sydney, let alone Cape Town. It's not true, and you've got to then just be careful with that.
Great. Thanks, everyone, for joining us today. The recording and the webinars will be available on YouTube shortly. And if you took value out of it, please feel free to share with your friends and colleagues. And we'll see you again next month.